Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the weekend review where I talk about current events for the everyday investor and home buyer. Our topics for this week, topic number one from RNZ on the 12th of November, average house values little changed from the start of the year. Topic number two from Oneroof on the 13th of November, Tony Alexander, where Kiwis plan to splash the cash, now rates are falling. Topic number three from RNZ on the 13th of November, wanting to sell your house? It may take 7 years before you don't face a loss. Topic number four from Good Returns on the 14th of November, government takes risk-based approach to deposit guarantee scheme. And topic number five from interest.co.nz on the 14th of November, housing market warms over spring, but it's not exactly tropical. So first up this week in review, and all the links are in the description below if you're watching this on YouTube. RNZ on the 12th of November, average house values little changed from the start of the year. House values in New Zealand remain mostly unchanged through October, with minimal growth seen since the beginning of the year, according to the latest QV House Price Index. Nationally, average home values decreased by 0.8% over the 3 months to the end of October, a milder decline than the 1.6% drop reported in the previous quarter. QV's operations manager, James Wilson, explained that the housing market has remained flat, with only a slight 0.3% decline in the average home value since January, now at $902,231. Despite recent interest rate cuts, Wilson noticed that economic headwinds continue to limit housing market growth. Most major urban areas experienced minimal change, with small rolling declines in Auckland, down by 0.8%, Christchurch down by 0.2%, Hamilton down by 0.6%, and Tauranga down by 1.6%. Wellington saw an improvement, with the rate of home value decline slowing to 2.3% from 3.2% in the previous quarter. Wilson attributed the sluggishness to factors like job insecurity, which is particularly felt in the capital. While some cities, such as Nelson, with an increase of 1.3%, Queenstown with an increase of 1.2%, and Whangarei with an increase of 0.3% showed slight growth, Wilson pointed out that ample property supply and rising unemployment is keeping prices subdued. However, he noted increased consumer optimism amid expectations that the Reserve Bank might further reduce the OCR, the official cash rate, in their announcement on the 27th of November. First-time home buyers remain the most active in the market, though investors and owner-occupiers are also gradually returning. Still, housing affordability is a persistent challenge as potential buyers balance lower interest rates against concerns over job security and rising unemployment. But in my opinion, still a buyer's market, plenty of opportunities out there. If you're in a position that you can get lending to purchase the property that you're after and it makes sense for you in your financial position, this is a great time to be getting your foot on the property ladder. So I'm pleased to see that there's a number of first-time buyers that are making up the largest chunk of the purchases in the current market. Topic number two from Oneroof on the 13th of November, Tony Alexander, where Kiwis plan to splash the cash, now rates are falling. Every month, 5 surveys are conducted to offer real-time insights on economic and housing market trends. One survey focuses on people's spending plans for the next 3 to 6 months, providing useful data for sectors like retail and home renovation. These insights are especially timely now as businesses await the effects of recent interest rate cuts. 5 months ago, a record 42% of nearly 700 respondents intended to cut back on purchases for the rest of the year. This sentiment has since improved, with the latest survey showing a balance. Just as many people now plan to spend more as those who plan to spend less, yielding a net 0%. This is the best outcome since December 2021. 2 specific areas show noteworthy trends. First, a net 13% of people report plans to increase spending on home renovations. That's up from June's net 11% reduction. Renovation projects, often costly and risky, typically indicate strong consumer confidence. This result suggests a robust improvement in sentiment and willingness to spend on major expenses. Also, potentially, the fact that there's lots of tradies out there that aren't working at capacity at the moment. So it's a good time if you're in a position to get some renovations done. It's a good time to find some tradies to do it for you. Secondly, there's been a significant reduction in plans to cut back on dining out, with only a net 11% planning to spend less, compared to 44% in May. Though still slightly negative, this trend may soon turn positive. However, the remaining caution suggests potential closures of dining and drinking venues may continue into summer. Other findings reveal a slower recovery in vehicle purchases, with 10% of respondents still planning to spend less, which is a slight improvement from May's 16%. This points to ongoing challenges for car dealerships. Travel, however, shows positive signs. For international trips, a net 10% now plan to travel more, and for domestic travel, a net 9% are planning more local trips compared to 17% reduction in mid-year. This trend bodes well for summer tourism, boosting demand for local accommodations. Regarding the housing market, while buyer demand has risen, it's not causing a frenzy as property listings have also increased. A net 7% of respondents have no plans to buy an investment property. That's an improvement from 19% in June, but it's aligned with the long-term average. Similarly, a net 4% plan to reduce spending on a primary residence, an improvement from June's 10%, but still showing a restrained demand. Overall, while housing activity is on the rise, it remains moderate. And I suspect in a few years' time, there'll be people regretting their decision to delay entering into the property market in 2024 or 2025. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor, and these events are available live online or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website, propertyapprentice.co.nz. Topic number 3 from RNZ on the 13th of November, wanting to sell your house? It may take 7 years before you don't face a loss. CoreLogic reports that homeowners who bought at the market's peak may face a wait of up to 7 years before they can sell without incurring a loss. According to the latest Pain and Gain report, 9.8% of property sales in the third quarter of 2024 were loss-making, rising to over 16% in Auckland. This is up from 8.2% in the previous quarter and marks the highest rate of loss-making sales in nearly a decade, though it does remain below post-GFC peaks. The median loss on these sales was $55,000, while profitable resales saw a median gain of $269,000. Loss-making properties had typically been held for nearly 3 years nationwide, with Auckland's median hold period slightly higher at 3.3 years. By contrast, properties sold at a profit were held for about 8.5 years. Kelvin Davidson, CoreLogic's chief property economist, noted that the market now favours buyers who have more bargaining power after the extended peak of 2021, when 99% of resales were profitable. He explained that the decrease in both the frequency and size of gains reflects ongoing softness in the housing market. Davidson pointed out that the longer hold periods seen in profitable sales indicate more cautious selling behaviour. He expects the current trend to persist, as ample listings could take several quarters to clear from the market. Properties held for shorter periods are particularly susceptible to losses, a trend amplified by price drops of up to 20% from peak levels in some areas. Davidson noted that while few intend to buy and resell quickly, unforeseen changes can necessitate early sales. House price growth, traditionally at 6% annually, may average closer to 4% in the coming years. Davidson compared the current market cycle to the GFC recovery, which took 5 years. He suggested that full recovery from the 2021 peak may extend to 2027 or 2028. I would like to point out that we are now back to median values, the same as where they were 2 months before the peak, at the end of November 2021. In that last 2 months period before the actual peak at the end of November, the property market increased significantly in value and then obviously had a significant decrease after that. So we're right back where we were 2 months before the peak of the market. So this is obviously going to hit those who purchased right at the peak the hardest. People who purchased a couple of months or 3 months before the peak might not be so bad. Investors have been hit harder than owner-occupiers, with 11.1% of investor sales incurring losses in Q3, up from 8.5% in Q2, making a decade high. I suspect that those were properties that were purchased either off the plans, where they paid full purchase price and then had a significant correction with potential rent changes over time as well. So people buying off the plans, new build developments, and then the market settled down into a different section. So yeah, it's a difficult time to be buying property off the plans at the peak of a boom. It is certainly the highest risk stage to be doing that at. Meanwhile, loss-making resales for owner-occupiers rose to 8.8%. Davidson linked this trend to cash flow difficulties, especially with mortgage rates still high, and noted that some investors may be cutting their losses to focus on better performing assets. The report also highlights a substantial gap between apartment and standalone house performance. 35% of apartment resales incurred a loss, compared to only 8.9% of houses. Apartment values they do tend to be a bit patchier with capital growth over the long term, and we certainly saw a significant correction in values during COVID. So yeah, there are times where things are quite dire for the apartment market, but potentially you'd be buying at the bottom of the market if you were buying in the current apartment market, especially in Auckland at the moment. Davidson explained that while investors are often drawn to apartments for their yield, these properties are more vulnerable to market shifts. Despite higher loss rates in apartments, there's no sign of fire sale pricing, with many investors choosing to absorb losses rather than hold underperforming assets. Among major centres, Auckland led in loss-making sales at 16.1%. That's up from 12.9% in Q2, while Wellington also saw an increase, reaching 9.9%. Topic number 4 from Good Returns on the 14th of November, government takes risk-based approach to deposit guarantee scheme. The new Depositor Compensation Scheme, DCS, will use a risk-based funding model, placing most of the cost on New Zealand's 4 largest banks, while smaller institutions will initially pay a flat fee, Finance Minister Nicola Willis announced. Levy amounts for banks, credit unions, building societies and finance companies will depend on their size and risk level. The levy is calculated based on total deposits covered by the scheme, with the 4 largest banks shouldering about 75% of the total cost. Set to launch in July next year, the DCS will protect depositors up to $100,000 each in the event of a deposit taker's failure. Treasury projects that the scheme, with a fund amounting to 0.8% of protective deposits, could require up to $1 billion in initial payouts in such cases. Smaller institutions like credit unions and building societies will pay a temporary flat levy until 2028, allowing time to adjust under evolving regulations. The government's decision reflects a Commerce Commission recommendation to avoid overburdening smaller entities until the DCS impact is clearer. The scheme is also anticipated to boost competition, as Willis noted that New Zealanders may feel more comfortable switching deposit takers, knowing that their deposits are protected in case of failure. The DCS's effect on competition will be closely monitored over time. And the last topic for this week in review, topic number 5, interest.co.nz on the 14th of November. Housing market warms over spring, but it's not exactly tropical. In October, the housing market appeared to show signs of strength, with the Real Estate Institute of New Zealand, REINZ, reporting 6,681 residential sales, which is a 10% increase from September. The national median selling price also rose by 1.9% to $795,000. These figures suggested a positive market heading into the summer months. However, a closer look at the data raises some doubts about the market's overall strength. While the raw sales numbers were up, seasonally adjusted figures actually showed a 2.6% decline. This drop could partly be attributed to the extra Saturday in October this year, compared to last year, which may have affected sales timing. Moreover, although the median price rose by 1.9%, the RINZ House Price Index, or the REINZ House Price Index, which is a more reliable indicator adjusted for property mix, showed a modest increase of just 0.5%. This suggests that while prices are rising, the pace of growth is still relatively slow, which is great for buyers. The most significant change in the market was a 7.7% rise in new listings compared to September, leading to an increase in total stock. RINZ Chief Executive Jen Baird noted that buyers are cautious due to high interest rates, which has made them more strategic in negotiations. The increase in available properties offers buyers more choices, allowing them to take their time and find options that better meet their needs. I think it is important to point out that at the moment, the only interest rates that are above the long-term average is the floating interest rate and 6-month rates. The long-term average interest rate in New Zealand over the last 20 years, leading up to the period where interest rates were slashed during the COVID pandemic, long-term average interest rates are 6.33%. So, we are starting to get below average now. I think people still compare the interest rates that we've got at the moment to the ridiculously low levels that we saw during the COVID pandemic at 2.5 and 2.99%, which is abnormally low for the New Zealand property mortgage market. Don't miss out on this valuable opportunity to get expert insights and proven strategies for property investing. Register now for How to Succeed with Property Investing. And these events are available both online and in person, and they're free to attend. Whether you're a seasoned investor or just starting out, these free sessions will equip you with the knowledge and tools to make smarter, more informed decisions. Join us to stay ahead of the curve and take the next step towards achieving your financial goals. In our free events, we'll also tell you more about how we help our clients to achieve their investing goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and sign up for one of our free events. If you've already been to one of these free events and you'd like to know more about how we can help you on your journey, book a no-obligation phone call or meeting with my husband Paul Roberts through the website. That's propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.